November 8, 2001. A single filing drops into the SEC system, a quiet digital tick in the otherwise deafening roar of the financial world. But this filing isn't just an update. It's a confession wrapped in jargon. It signals that Enron must restate its earnings, not just last year, but stretching back 4 years. A stunning $586 million error eroding their claimed success. How could a company deemed the most innovative energy trader on the planet suddenly find itself drowning in numbers it couldn't reconcile? The answer lies just 2 days later, in a deal so flimsy and so poorly documented it became the structural fault line that brought the entire skyscraper down. The air in Houston had felt electric for months, thick with the promise of infinite growth, but underneath the veneer the debt was suffocating. Enron was a masterpiece of financial engineering, a structure built on complex derivatives and special-purpose entities, shell corporations designed to keep liabilities off the main balance sheet. But that structure was buckling. The solution, they believed, lay in a desperate marriage with Dynegy, a large natural gas marketer. This wasn't a merger of equals, it was a high-stakes transfer of poison. The central mystery revolves around the final rushed agreement executed on November 9, 2001. It was supposed to solidify the merger, but within its hastily written clauses was the mechanism Enron hoped would save them, a massive debt offload. The aim was to shovel Enron's toxic liabilities, billions in obligations hidden in those very SPEs, onto Dynegy's books using a convoluted equity financing structure. The documentation surrounding this transfer was shockingly thin. This wasn't standard procedure. It was a paper-thin disguise for insolvency. Imagine trying to move a crumbling skyscraper onto a solid foundation, but only sketching the blueprint on a napkin just before the demolition crew arrives. Dynegy, supposedly securing the deal with a $1.5 billion cash injection, was meant to absorb the shockwave. But the people reviewing the paperwork, the few outside directors and nervous internal accountants who could even parse the arcane language, began to see the cracks immediately. This deal relied entirely on the assumption that Enron's stock price would hold steady long enough for the accounting maneuvers to settle. The rule being exploited, the subtle manipulation of GAAP rules like FAS 140, was meant to mask the true nature of the debt as capital rather than liability. As the days bled into one another following the November 9 filing, the market's scrutiny intensified. The $586 million restatement had shattered the illusion of perfection. Every analyst, every regulator, began peering past the spreadsheets, searching for the real Enron. They weren't looking for minor errors. They were looking for the mechanism that kept the whole edifice standing. And that mechanism was now officially tied to Dynegy. The atmosphere shifted from intense productivity to outright panic. Inside the headquarters, screens flickered with rapidly dropping share values. The noise of the trading floor, once a symphony of ambition, became a cacophony of desperate calls and slamming phones. The complexity that had once been Enron's armor now became its greatest weakness. No one could quickly trace the debt being dumped. Then came the realization. Dynegy's side wasn't fooled by the rushed documentation. They saw the true exposure they were inheriting. The assurances made by Enron executives, the promises that these SPEs were sound, rang hollow against the reality of the numbers being pushed across the line. The deal that was meant to be Enron's lifeline became its immediate execution order. The immediate collapse of the Dynegy deal marked the beginning of the end for Enron. Once Dynegy balked, realizing they were being handed a financial grenade, the market knew. The secret debt remained on Enron's books, suddenly visible, suddenly real. The confidence evaporated in a matter of hours, plunging the stock price below $1 before the month was out. Think of the irony. A company that dealt in futures, that claimed mastery over energy markets, was undone not by a shift in supply or demand, but by the sheer weight of its own unrecorded obligations, transferred in an agreement so poorly documented it was instantly voidable. The shell corporations were not just hiding assets. They were hiding the imminent collapse. The transfer was designed to give Enron breathing room, a temporary clean slate, but instead it exposed the rot entirely. The failure of that November agreement ripped away the final layer of pretense. There was no lifeline coming from Dynegy. There was no secret accounting trick left to deploy. The harsh, unflattering light of regulatory scrutiny hit the books, revealing nothing but insolvency. Within weeks, the empire that had promised endless returns filed for Chapter 11 protection on December 2, 2001. the largest bankruptcy filing in U.S. history at that point. It wasn't the derivatives that killed Enron. It was the paper, or lack thereof, surrounding the desperate final attempt to push the debt onto someone else's ledger. The poorly documented 2001 agreement didn't just trigger the collapse, it was the moment Enron admitted, by its own frantic actions, that it was already dead.